both gold and the US dollar will do well in the next 18 months. That gold, and in particular gold stocks, will give up some of their gains and build a base and grind higher. What I really like, in fact, about the gold market this year, it hasn't been straight up, but rather it has just been grinding higher. And what I like even more is that the equities haven't rocketed higher based on gold strength. The subdued nature of this gain, to me, is evidence of market breadth and strength. The Barron's Gold Mining Index, and it's very interesting, going back 40 years, the up cycles have varied in length from as little as 9 months on technical rebounds to as much as 6 years. What's equally interesting to duration is the magnitude. The magnitude is truly stunning. Of the 11 upcycles that I studied on the graph, the worst of them generated 150% return in the equities. The best of them generated 1,200% return in equities. Chart. We are either approaching at or just off the bottom. The upside has somewhere between 9 months and 60 months. If you follow the thesis that you opened with, that bear markets are the authors of bull markets, the bear market that we've been through in the period 2011 to 2019 was at once very long and very deep. That would suggest that the recovery could be similarly long. Time will, of course, tell. What's more important in this context, I think, than discussing history is looking at the fundamentals. And the fundamentals really go, I think, to fiat currencies around the world in negative yield categories and their impact on the US dollar. Because I really think that the most important variable with regards to the gold trade and the gold equities trade is faith in the long-term purchasing power of the US dollar, which the US government seems to be doing their very best to undermine. The gold trade that you're seeing right now is not momentum oriented. People aren't flooding into gold because it's up 14% off its lows. People are flooding into gold because they're afraid. Later in a bull market, when precious metals have moved, momentum traders come in, the greed traders. And the people who are interested in precious metals as a consequence of cashing in on a bull market, maybe the equity investors, historically have done better in silver, and better yet in silver equities. Silver moves later than gold because the bull markets are always kicked off by fear but extended by greed. But silver traditionally has been more volatile to the upside and the downside, meaning in the bull market, it outpaces gold. But the best speculative asset class historically has been the silver equities, that is, leveraged calls on silver. That's because silver stocks are very rare. In down markets, they go almost extinct. High quality silver equities are rarer. There are probably 10 or 12 silver equities in the world that an experienced analyst can recommend with a straight face. And in a precious metals bull market, the rarest, most leveraged asset class ultimately moves the furthest. And one would have to suspect, if past is prologue, that when this bull market gets underway, for those people who have the courage and can handle volatility, the high quality silver assets will be the asset class to be in. Bonds are a promise to pay. Gold is not a promise to pay, it's payment. It is an asset that isn't simultaneously somebody else's liability. If you own a bond, you are counting on the fact that somebody will pay you interest and that they will pay you principal. If somebody gives you gold for a transaction, they aren't promising to pay you, they've already paid you. The medium of exchange is the store of value. It could be argued that a well-collateralized bond from a solvent society represented a reasonable and just claim. While it wasn't simultaneously payment, it represented a promise that had a reasonable chance of being fulfilled. My belief is that the central banks have fewer levers at their disposal than they did in 2011. If we had a circumstance now, as an example, a liquidity squeeze of the type that we had in 2008, in 2008, there was lots of room to let real interest rates fall. There was still pent-up demand for income and bonds. So the tools that were available to suppress a financial crisis and ultimately to suppress the gold price are less abundant and less robust now. How far can you cut a negative interest rate? In many parts of the world, there were positive or decidedly positive interest rates, at least nominal interest rates, less so inflation adjusted. But those interest rates are now so much lower that one wonders about the fiscal terms that could be put in place to deal with a liquidity squeeze. If they attempt to deal with a liquidity squeeze the way they did last time, which is to pump more liquidity in the system and take the yields decidedly negative, I suspect that the gold reaction that you would see would begin to resemble the gold reaction that you saw in the beginning of the decade of the 1970s. Personally, that you start a precious metals portfolio with precious metals. The first thing you do if you think the gold price is going to go up, you buy some gold. That's the anchor of a gold portfolio. Similarly, if you think that silver is going to go up and you're more speculatively inclined than insurance inclined, you buy some silver. I care less, frankly, about the form that they buy it in, although I would prefer it said Sprott. The important thing is, if we're going into the circumstance that I suspect both you and I believe we're going into, you begin those portfolios by buying the asset itself, not a proxy for the asset, which is the share. Irrespective of gold, irrespective of the gold price, I will always own some gold. Certainly, if we went to a circumstance where the gold price was 5,000, but the interest rate paid on a US 10-year treasury was 6 or 7, with the underlying inflation rate at 3, I would sell some gold because it would be relatively less attractive. Before I sold my gold, I would also certainly be selling some or most of my gold mining stocks, because with gold at $5,000, ironically not as cheap as it is today at $1,500, the gold constituency would be enormous. And we would be able to look at the 40-year gold mining index chart from Barron's magazine from a lofty as opposed to a low position. Remember that buying low and selling high involves two actions. It involves buying low and it involves selling high. So certainly for the investor, rather than the sort of insurance owner in gold, you need to sell some when the prices go high in order to maximize your benefit.